All right, kudos to you who are watching the news and have reached out and said, wait a minute. I'm hearing about some changes to my loan. And you're hearing part of the information that you need to know. Okay, so effective today, May 1st, there are some pretty big changes that are coming down the pipe for most new loans that are closing today and moving forward. And depending on your news source, you may be hearing bits and pieces of the truth. And so I wanted to give you the deets. All right, let's get down to the details. So this news applies to the loans that are backed by Fannie Mae and Freddie Mac. So this is the majority of new mortgages, but it's not FHA, VA, jumbo loans, or those that are from a retail bank or credit union. Okay, so let's start with that. If you have an existing loan on your home, this new law does not affect you until you go to buy another property if you're using a Fannie Mae or Freddie Mac backed program. Okay, so the Federal Housing Finance Agency announced their decision to change the upfront fees for Fannie Mae and Freddie Mac. So they actually made this decision back in January. And so most loan originators have been working this into the fee plan for people that are closing from today forward. But it didn't actually start till today. So they are saying that they wanted to do this to facilitate equitable and sustainable access to homeownership to make it fair for everybody. The National Association of Realtors, of which I am a member, has publicly opposed these changes and doesn't really believe that an increase in fees is needed at this time, or maybe that it's not going to achieve what we're being told that it might. So the story has been, and what people are hearing, higher score borrowers are going to be paying the penalties and helping subsidize lower scored borrowers. And that's not exactly how this is going to go. So what they call loan level pricing adjustments have always existed for Fannie Mae and Freddie Mac loans. And the buyers will now pay more for the rate, or they're going to get a higher rate if they don't have 25% plus to put down, and their credit score is below what the government thinks is a good score. So this extra money, this extra cost isn't actually going to the bank or the person that's originating the loan. So some borrowers won't have enough funds for the down payment and the costs that are going to be associated. So they'll have to take a higher rate that offers less cost, or maybe go FHA or VA if they qualify, etc. So that's kind of what I've learned. I've been doing a lot of research. I've been trying to understand it myself. I may have relayed some information incorrectly. I'm doing my best, but get good facts. What are your sources? What are my sources? Mortgage Daily News. I have some fabulous local lenders who I've been picking their brains on this. The National Association of Realtors, and the Federal Housing Finance Agency, all places that I've gone to do my digging and try to better understand what we've been hearing. Okay, now there are 7 main things that go into determining a rate. This is really what I want to leave you with. Number 1, loan to value. So how much of a loan is somebody taking, and what is the value of the home? The loan amount. How much is the loan for? The length of the loan term, 15-year, 30-year. What is the borrower's credit score? How creditworthy are they? What's the property type? What's the purpose of the property? Primary home, secondary home, investment property, etc. And last but not least is the borrower's debt to income ratio. So all 7 of these things factor into what interest rate you are going to be offered when you go to buy a property with a loan. So I hope this is helpful to you. I would love to connect you with some actual experts in this particular field. Again, I was doing research. You've probably done some research, but there are people that live, breathe, and work in this space all day long, and I would love to connect you with them if you need us to here at the Russell Company. We're at 497-0700.